Hello traders, welcome to the first lecture of price action lecture series. In this session, we'll be discussing about the basics of price action trading. First, let us see the definition of price action trading. Price action trading is a chart reading technique which helps us to analyze the swings or the movement in the stock market without the help of any indicators. This is a chart with indicators, and this is the same chart without any indicators. Can you see the difference? Can you see how clean this chart is? This simple chart has all the necessary information that is required for us to find trading opportunities. By the end of this course, we'll be showing you how to read charts without any indicators and find trading opportunities. In the stock market, the stock always moves in swings. For example, let us say there is a stock named ABC Private Limited and the opening price of the stock is $100. And the closing price of the stock is $150. Most of the time, the price of the stock does not reach its target directly like this. The stock moves in zigzag or it always makes swing like this before it reaches its target. Traders, these are the swings I'm talking about. Can you see the stock making a swing like this? Another swing like this? And another swing like this? There were a lot of buying and selling opportunities here. Once you learn price action, reading and analyzing these swings will be very easy. You can easily find buying and selling opportunities with the strategies which we teach you. Before we discuss about the strategies of price action, we need to discuss about the rules. I call them the golden rules of price action trading. Do not worry, these rules are very simple and easy to understand. At the same time, they are very effective. These are the three golden rules of price action trading. First rule, higher low plus higher high is equal to uptrend. Rule number 2, lower high plus lower low is equal to downtrend. Rule number 3, rest everything is sideways or consolidation. Let us understand these rules one by one with an example so that it's easy for you to understand. Okay, let's start off with rule number 1. Higher low plus higher high is equal to uptrend. Let us say the market opened today at $10. We will call this low. Now let's say the stock reached $35. We will call it high. The stock again went down to $20. Let us call it higher low. And finally, the market went up and closed at $50. We will call this higher high. Now we call this higher low because this low is higher than this low. And we call this higher high because this high is higher than the previous high. There is an important note. For uptrend, we need to start from low, high, higher low, and higher high. When this is visible in the chart, we call it as uptrend. It is important that higher low and higher high has to be formed for us to consider the trend as an uptrend. If higher low and higher high is not formed, then we cannot consider this as an uptrend as the rule is not complete. As soon as you see the stock is making higher low and higher high, it is a confirmation that the stock is making an uptrend and we need to look for buying opportunities. Now let us discuss about rule number 2. Rule number 2 is lower high plus lower low is equal to downtrend. Now let us see how to use this rule to identify downtrend. In this example, the current price of a particular stock is $50. At the $50, we will mark high. Now let us say the price of the stock decreased and went down to $35. We will mark it as low. And slowly the price of the stock went up and reached $40. We will mark it as lower high. And finally the stock price became $20. We call this as lower low. Now, we call this lower low because this low is lower than the previous low. And we call this lower high because this high is lower than the previous high. As soon as you see the stock is making lower high and lower low, it is a confirmation that the stock is making a downtrend and we need to look for shorting opportunities. Traders, trust me, once you start using these rules and identify uptrend and downtrend, you will find so many opportunities to enter a trade. Trend identification is the most important part of technical analysis. Consider that you have won 50% of the battle if you identify the trend properly. These rules can be applied when you're trading with stocks, commodity, future, currency, ETF and cryptocurrencies. Also, these rules can be used in all time frame. That means these rules can be used when you're trading in intraday and swing trading. Traders, I hope you understood the concept of uptrend and downtrend. Now, before we discuss about the third rule, we need to understand that we are price action traders. We make use of the swings that happen in the live market to identify trading opportunities. What do I mean by this? Let us see that now. In the live market, the stock can make only three types of movement. The stock can go up like this, the stock can go down like this, or the stock can move in sideways like this. You can pick any chart and see. You will notice that the stock is making any one of these three moves. If the stock is going up, we will say that the stock is in uptrend. If the stock is going down, then we call it as downtrend. If the stock is moving sideways, then we call it sideways or consolidation. As price action traders, we will trade only when the stock is in uptrend or downtrend. During uptrend, we will look for buying opportunity. During downtrend, we will look for shorting opportunity. But if the market is in consolidation, we should not enter the trade. Now let us understand why we should not trade during consolidation. If the stock is in consolidation, it means that the stock is moving within a range and it is unable to break the support level or the resistance level. If the buyers win, the stock will break the resistance level and go up. During this time, we can look for buying opportunity. If the sellers win, the stock will break the support level and go down. During this time, we can look for shorting opportunities. If the stock is within a range, then we should not enter the trade. If you enter a trade during consolidation, there are high chances for the market to go against you. And also, the duration taken to achieve a target during consolidation is very high. So this is the third rule. We should not enter the market when it is sideways or consolidation. Until now, we have discussed all the rules with drawings so that you can understand this in a simple manner. But in the live market, everything happens in charts. In the next lecture, we will be showing how to find trend in the live market, how to find trading opportunity in the live market, and also we'll be discussing the price action strategies. Traders, that's all for this lecture. I'll see you in the next one.